The expectation for rate hike in December 2025 from Bank of Japan, which has been rattling global financial markets, is continuing to rise. As a core financing currency for global carry trade, the pivot of monetary policy from BOJ has raised deep and comprehensive assessment and judgment from financial institutions, including Goldman Sachs, Morgan Stanley, JP Morgan, and UBS. Its impact on liquidity, bond, and equity markets will present significant divergence. Morgan Stanley views the rate hike in deck as the base case scenario, citing yen as the water source of global liquidity. Rate hike will trigger capital return of carry trade, which will result in the tight liquidity. Morgan Stanley also points out that the risk assets, such as growth stocks and high-return bonds, have been under pressure for a while. Nikkei 225 has declined 1.9% based on the expectation rate hike, and the contagion risk on global market is also rising, which has raised concerns among investors. The warning and cautious stance from JP Morgan is more severe, as it estimates that the yen carry trade, which is worth $1 to $2 trillion, will accelerate the reversal capital, and the capital mostly flow into megatechs and emerging markets bonds, and capital flight will entail huge volatility for global equity market. Meanwhile, as the largest holder of U.S. Treasury, Japanese investors may reduce their holdings by $1.1 trillion and shift towards domestic bonds, which would push up U.S. bond yields by 20 basis points and lead to a 5 to 10% drop in the U.S. dollar index, exacerbating huge volatility in currency market. On the flip side, Goldman Sachs, which attributes the lack of liquidity to the seasonal volatility, is relatively optimistic about the move of rate hike, estimating the tight liquidity will ease in the wake of the end of QT. Also expecting the rate hike from BOJ will delay until January 2026, insisting that short-term impact will not result in continuous volatility in financial market. The stance from UBS is more reasonable, pointing out the position of yen carry trade is approximately $500 billion to $1 trillion, which is not enough to entail systemic risk. UBS highlights that the impact from the fluctuation of currency is greater than rate move. If the Japanese yen continues to depreciate, arbitrage funds may even expand. So the impact of rate hike is more of a temporary and short-lived.